Propose a progressive wealth tax, and you'll immediately encounter a standard political counterargument. The ultra-rich will pack up and move their money across the border. Testing this claim is notoriously difficult. You can't just look at a country's GDP before and after a wealth tax is passed to see the damage. That is because a national tax change alters multiple economic variables at exactly the same time. The tax might reduce domestic savings rates or incentivize people to hide their money offshore. This creates a classic endogeneity problem. If you only look at the top-line GDP, you cannot untangle the specific economic damage caused by physical migration from the damage caused by all those other behavioral changes. A 2024 working paper from the National Bureau of Economic Research bypasses this roadblock. Using decades of exhaustive administrative tax data from Sweden, the researchers built a two-step framework to isolate the macroeconomic cost of millionaires leaving the country. To do this, they break the problem down into the single mathematical framework you see here. The total aggregate economic impact equals the migration elasticity, multiplied by the migration impact, multiplied by the top wealth share. Let's look at the first term. Migration elasticity measures how sensitive wealthy individuals actually are to changes in the tax rate. Do they leave immediately, or do they stay? The second term, migration impact, isolates the microeconomic damage at the firm level. When an entrepreneur packs up and leaves, what happens to the specific business they leave behind? The final term is the baseline. Top wealth share measures the total economic footprint these wealthy individuals control in the broader economy before any taxes change. Solving these three variables independently strips away confounding factors like tax evasion and savings rates. We can calculate the exact penalty of wealthy capital flight. We start with term 3 to establish the baseline stakes. In Sweden, the wealth tax primarily targeted the top 2% of households. The data shows this group rarely just holds passive assets. They are heavily overrepresented as owners of closely held businesses. To measure their true influence, the researchers mapped out indirect ownership. Wealthy taxpayers often control a massive share of the workforce through complex holding companies and subsidiaries, meaning their economic footprint extends far beyond their direct investments. This chart visualizes that concentration. The tiny demographic sliver on the left represents the top 2% of the population. But the area on the right shows their economic weight. Through their businesses, this specific group controls nearly 10% of total Swedish employment. The concentration becomes even more extreme at the very top. The wealthiest 0.1% of households alone control over 3% of all jobs in the country. Because domestic employment is heavily concentrated in the hands of so few people, the underlying fear driving the wealth tax debate is mathematically valid. The departure of even a small number of these individuals poses a structural risk to the national labor market. That brings us to term 1, the elasticity of migration. We know these individuals control a massive share of the economy, but we need to know if higher taxes actually push them out. A sudden political shift provided a perfect test case. Following the 2006 election, a new coalition government took power and completely abolished the Swedish wealth tax, effective January 2007. This total repeal allowed the researchers to run a difference-in-difference analysis. They compared a treated group, the top 2% who were paying the wealth tax, against a control group composed of individuals whose wealth was just below the exemption threshold. Look at this chart mapping the out-migration rates. The pre-trends track identically before the 2007 reform, but exactly at the zero line, when the tax was abolished, the out-migration rate for the treated millionaires sharply drops. The propensity of wealthy individuals to leave the country decreased by 30% compared to the control group. Mathematically, this translates to a semi-elasticity of negative 0.17. The tax rate was a significant driver of the decision to migrate. However, context is critical. Look closely at the y-axis. While the relative 30% drop is behaviorally significant, the baseline out-migration rate for the wealthy is remarkably low. Only about 0.2% of wealthy taxpayers leaves the country in any given year. To understand why this matters, we have to look at demographics through an overlapping generations model. In economics, you separate the flow, the people moving in and out every year, from the stock, the total stationary population of wealthy individuals inside the country. Because the annual flow of migrants is a tiny fraction of the total population, Even a highly sensitive flow response barely dents the total tax base. The data shows that a 1 percentage point increase in the tax rate only shrinks the total aggregate stock of wealthy people by roughly 2% in a steady state. Taxes strictly govern the marginal flow of millionaires crossing the border, but the massive inertia of the existing population means a wealth tax will not hollow out the country's tax base. Now we have to solve term 2. Even if only a small number of millionaires leave, they control a massive number of jobs. We need to track exactly what happens to a business when its owner exits the country. The researchers used an event study design. They pooled all first-time out-migration events, designated the year of departure as time 0, and compared the trajectories of those specific firms against a randomized control group of owners who stayed. This scatter plot tracks firm employment around the time of migration. Up until time 0, the firm operates normally, but the moment the owner leaves, the firm experiences a massive drop. On average, employment falls by 33%, and value added plummets by 34% in the years immediately following the departure. If we stop the analysis here, this data confirms the standard trickle-down warning. Millionaire flight destroys localized business activity and gets workers fired. But raw tax registries can be misleading. When a firm disappears from the administrative data following a migration event, it does not necessarily mean the physical factory shut its doors and everyone lost their jobs. By cross-referencing the Swedish company's registration office, we see a reallocation effect. 45% of the firms that supposedly closed when their owner left were actually absorbed by other domestic firms through mergers and acquisitions. When you account for those buyouts, the negative impact on the firm levels out considerably. To see the real human cost, the researchers ran a worker-level analysis to track the exact employees displaced by the remaining closures that did occur. The data shows that the Swedish labor market quickly reabsorbs these individuals. After their previous firm closes, the displaced workers find new jobs so rapidly that they experience only a 4.3% persistent drop in labor earnings over the long term. The domestic market acts as a macroeconomic shock absorber. When a wealthy owner abandons an asset, the surrounding economy buys up the firm and hires the displaced workers, neutralizing the trickle-down damage. But there is one more way a wealth tax can lose money. Even if we ignore the migration of people, we cannot ignore the behavior of the capital that stays behind. This is the intensive margin. It accounts for revenue lost when a taxpayer remains in the country but changes their behavior, perhaps by reducing their savings, shifting their investments, or exploiting loopholes to hide their assets from the tax authority. To put the migration numbers in perspective, the researchers compared their Swedish findings against established estimates of domestic avoidance. This allowed them to measure the fiscal externality of the wealth tax, essentially calculating how much revenue is lost for every dollar the government attempts to raise. Returning to the mathematical framework we saw earlier, we can now plug in the solved variables. We have a highly inelastic population stock, a firm impact that is heavily mitigated by local buyouts, and a granular baseline wealth share. Multiplying these three terms gives the general equilibrium calculation for the aggregate penalty of wealthy capital flight. The total macroeconomic cost is exceptionally small. A 1% wealth tax increase decreases aggregate national employment by only 0.02% and total value added by just 0.10%. These findings isolate the true source of fiscal leakage. Physical migration is a secondary concern compared to the behavioral changes of the people who choose to stay. For every $1 of revenue raised by the wealth tax, only 22 cents are lost to migration responses. In contrast, 54 cents are lost to evasion and savings changes at the intensive margin. Lawmakers routinely spend their political capital designing aggressive exit taxes and debating the dangers of capital flight. The data suggests they are guarding the wrong door. They should be focusing their legislative effort on enforcing domestic compliance and closing accounting loopholes. Millionaire flight is a behaviorally real phenomenon, and it makes for potent political rhetoric. But mathematically, it is an economically negligible threat compared to the capital that stays within the borders and hides.